Hello, welcome to Ask the Planman. Everything you want to know about insurance, finance, and more, but we're afraid to ask. I'm your host, Bruce Weinstein, and today we're rejoined by John Browning with Guardian Rock Wealth Management, and we're going to be talking today about the things Wall Street doesn't want you to know. Welcome, John, back to the show.
Thanks for having me, Bruce. Looking forward to our chat today, given everything that's going on in the market and has been for the past, just about 12 months, 18 months almost.
One of the things I wanted to get you back on the show is the way the stock market has been cracking and breaking down and tied to the spike in interest rates. And there are a lot of people out there wondering what the heck to do with their assets, their portfolios. They buy bonds, they go to cash, they sell out. There's pain being felt. So we're going to cover today, hopefully for the audience, some of the buzzwords you and I have been used to saying over the years, like catch a falling knife and dead cat bounce and capitulation. So I kind of want to get into that. But the foundation of this, I started saying, is what Wall Street doesn't want you to know is that the average consumer is treated no more, my opinion, as a distribution channel. Meaning Wall Street is more interested, makes more money on the institutional side of investing, including what used to be back in the day when you and I started, their own portfolios, and had a history of dumping their institutional positions without the street really being cognizant of it being a sell, and they would be recommending it to their retail clients, which was John B. Consumer, not to be with John Browning. And so the anecdote I had shared with you once previously was when I first started in the business as a young stockbroker in 1987, there was a stock that was being pushed and promoted that was given the highest rating that the brokerage firm ever gave a stock, meaning it was the safest stock, the dividend was secure, this was the little old lady stock. And they even had, wait for it, they had a commission incentive to get us to buy the stock for our clients. And so we're hammering the phones, we're putting clients into it. And of course, guess what happens a few months later? This company goes bankrupt.
Completely gone.
And I'm the schmo who put my client in that stock. And I'm like, but wait a minute. It was that the brokerage firm was the one recommending it. The brokerage firm put that high rating on it. The brokerage firm said it was deemed a safe little old lady stock. That's who's giving you this information. And I'll give you one more piece to it is again, back in this era, I was constantly told, I don't pay you to think, I pay you to sell. And so the brokerage firms wanted us to distribute the garbage on occasion, not every day, but when somebody was looking to get out of something or somebody knew something was going on, they needed a way to liquidate these positions. Have you had similar experiences?
Oh, absolutely. And they have put some safeguards, right, in place so that type of thing doesn't happen as much anymore. But one of the things that we do see, first of all, yes, I have seen that. Back in the early days when I was just getting started out, we would get, back in the day, I was really a bond portfolio manager, and we would get these bonds, right? And we would be told, get these out. And, at the time being a young, I was being a young guy on Wall Street. I just didn't know the real story behind it. And the real story was they wanted to dump that particular bond. And at the same time, they would have these enormous commission incentives for us to do that. I mean, by today's standards, it would just dwarf to anything you could drive. We used to say, you can drive a Mack truck through that spread, which means the difference between what we would get it for and the difference between what we would sell it to the end investor for. And it was really, really, really wide. But today, the difference is, and this is why I'm independent and you're independent, and why we have exited the big Wall Street firms. We learned a lot there, right? So they were great. We got a great education there, learned from some of the best minds in the business. But what you'll find if you look at your statement, and it's got all XYZ mutual funds, or whatever the firm is, it's got every single one of them, maybe a few exceptions, got that same mutual fund just different versions of that mutual fund by the same company, there's an indication there that your advisor might be getting some sort of kickback from that particular firm.
The fund family, like if the fund family is repeated over and over, a Lord Abbott, a Putnam, MFS, like so. How come I don't have anybody else in there except that family? You could say is being cajoled with a little bit of kickback or something. Now you said something before we lose track of it. Is just that things changed from back in the '80s. So I want to make sure I'm on the same wavelength with you and share it with the audience, not covered over. Is back in the 80s, the brokerage firms had their own portfolios and then also recommended what stocks to be buying. And they managed institutional assets. So think of a portfolio, maybe something you manage is, the big insurance companies have to put all that money to work that they collect for their premiums and their holdings. And so they manage for the spreads. And so they're giving Wall Street these big sums of money to buy stocks and bonds with. And so they're doing that. And then if somebody has 1 million shares of a stock they want to dump, well, how are they going to dump it? They they can't take it to the street because then everybody's going to know that Joe Blow's dumping, Fidelity's dumping all their Apple stock. Well, the whole street's going to catch on to that, and they're going to get in and want to sell it with them, right? So the distribution channel was, well, let's sell it to our retail clients. Like we can flip the inventory, basically self-deal, and get rid of it on one side of the books, but now we're going to spread it out over 10,000 retail clients and let them eat the garbage, right? And so part of that was that a firm like Merrill Lynch had Merrill Lynch Asset Management, which had its own portfolio of mutual funds that you could buy when I was back with them. And so now it's double dealing, and it was a conflict of interest, which eventually they were forced to sell, which I think that Merrill Lynch Asset Management's part of BlackRock, right? BlackRock. So they were spin-offs. So I think that's what you were alluding to. When you said that, right? So
that's exactly, well, that's part of it. And they were just the getting rid of their own inventory when they needed to, right? They saw something that they thought was going down, and they just simply would put that to the retail investor.
Yeah,
get them to buy it.
Now, on the subject of distribution channel, you and I have talked, and I've shared on my Facebook pages, March 31st, 2021. So last year now, 15 plus months ago, I had a headline come across my phone that Goldman Sachs was now offering their client base access to the Bitcoin and the cryptocurrencies. And I took a photo of that screenshot and I posted on Facebook. I said, I may not be the smartest guy in the room, but this screams run all over it, and run fast. The biggest lesson, I know, I'm sorry, John, I'm going on, is if what you need to understand as a consumer, if you're buying, why is the other person selling? And when you're selling, why is the other person buying? So never lose sight of the fact that there's somebody on the other side of that transaction. And the age-old problem for the average investor is they want to buy high and hope to sell higher. Whereas you and I are more contrarian. We're looking for value. We want to zig when everybody zags. It's kind of like that guy, you know his name, WB?
Warren Buffett.
Warren Buffett. Okay, Warren Buffett likes to buy when things are knocked down, drag out, again, it's a crude terminology. When there's blood in the street, it's time to buy. Right? And when everything's rosy and everybody thinks like, oh, it's only going to keep going up, and at 59,000 in the Bitcoin, or 60,000 for Tesla, whatever the Tesla's, like, it's just going to keep going up, and I just got to keep buying more. But nobody has an exit strategy and a discipline to say, you know what? I'm up 75%. I'm going to sell 5% of my holdings. I'm up 300%. I'm going to sell 5. Like, you need to do, and you and I did an episode on asset allocation, so we're not going to get too deep into it. But let me throw a question at you to let you get some airtime here. We're talking about the distribution channel and this. Sorry, I'm losing the words. When the Goldman came out with that statement of giving access, it put a stamp on it. And so from your experience, what have you seen where the buys really should have been a sell and the sells really should have been a buy? You have any experience on some of those famous stock calls over the years? I've got a
Oh
few.
yes, I lots of experience with those, and sort of a rule of thumb. And this is, I don't want to bash, the big companies or anything, but but generally speaking, the the general rule of thumb was, and I have friends at Goldman Sachs, and I did a lot of business with them over the years. But if Goldman Sachs is on one side of the trade, that's the side of the trade you want to be on. You don't want to be on the other side of the Goldman Sachs trade, because they're very good at what they do and consistently make money in up and down markets. So when that you see that happens, in particular with Goldman, it's generally a good indication. And we had, I will totally admit, when I was managing mutual funds and things like that, when we saw retail begin to pile in to even our own funds, we knew that that was probably the time that we needed to be pulling back. It's just a repeated over and over scenario in the marketplace. Now, sometimes you do have to be patient, Bruce, right? It doesn't happen overnight. We had a very long run in Bitcoin where it was just up, 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 up. And it was a little bit painful. People would laugh at you for not participating. Many of them had tax problems that they didn't realize, because they would get in, get out, get in, get out, get in, get out. And because of the way that the IRS chose to tax that, that's a whole nother story, right? We can do a whole nother episode on the tax ramifications. But I talked to a CPA friend of mine, and he said there are people who had no idea that they were going to owe so many taxes just because they were trading in and out of Bitcoin.
Some of the brokerage firms, what I started following and paying attention to was, inevitably, when I saw a sell recommendation, I would pull up the stock's price history, where that stock was, again, before computers had the charting capabilities to do technicals. But I had my own mental technical graphing. It was like, if a stock's between 20 and 30, and every time it goes to 30, it sells off, and it comes back to 20 and they buy it. Like, that's the band, and I could play in that band. And if it breaks 20, I'm in trouble. And if it goes above 30, it's going to make another run possibly, right? And so inevitably, every time I saw this one particular brokerage firm put out a sell recommendation, which you and I know is very, very rare for the street to actually say sell, which again is what Wall Street doesn't want you to know, and we're gonna tie that back in. So I'll come back to that one. And so I would basically look at them saying they're selling XYZ, and it's at the bottom. And now today they didn't want to sell it at 60, but now at 20 they're telling you it's time to sell. And I'd scratch my head like, you didn't tell me to sell it at 60. Why would you tell me to sell it at 20? And inevitably, it would go right back up, and that was the bottom. And so they were feeding the suckers the sell to get them to dump their portfolio, because guess what they were doing? They were looking to add to their positions now. They were seeing the clouds were clearing, and this was time to get back into the stock, but they need inventory, so they need the suckers to sell.
That's right. Exactly. That's exactly the way it worked. Yeah. And thankfully, those things don't happen as much as they did once at one time because of the regulations. However, it is just simply more subtle than that now, the way I see it, Bruce. I don't know if you agree with that, but just some of the things that I see.
I think it's just a different information age, right? Where so much is available with the Twitter and Google and chat rooms, whether it's accurate information or disinformation, stuff is being thrown out there. You and I talked in the past about how much people rely on a CNBC or an FNN, Financial News Network or something. And so the big message there is you want to listen, but you have to take everything with a grain of salt, because at 11 o'clock, they're going to have the bull, and at 12 o'clock, they're going to have the bear, and at 1 o'clock, they're going to have the inflation gold bug guy. And so now, are you shorting? Are you longing? Are you golding? Like, what are you doing? And so people get wrapped up like, well, this is the gospel because I saw John Browning on at 1:00 and he thinks gold's going to go up. Well, the point is gold may go up, but what you really need to ascertain with somebody like John or myself is how much money of yours belongs in gold. It's not, I'm going to move all in. I'm not at the casino, or shouldn't be at the casino. And I'm like, gold's the bet. I'm all in on gold. And I'm wiped out.
Well, the thing about the CNBCs and everything, because I've been on some of those shows and I know some of those folks, and they're good people, right? I don't know I've actually not met any of them that were just sort of out to get you or just bad people, and they're all very smart, super smart. But what would happen is we would be on the set. And sometimes you get a phone call, like literally 20 minutes, 30 minutes, maybe a couple hours. Hey, we need you on the set on CNBC. Can you be here? And you always said yes, right? Because it was exposure. And that's really why they're there. They want the exposure, and they're there to sell advertising for CNBC. And you just have to understand that. It's not that it's bad information or bad people, great people. And we would decide, hey, do you want to take the negative side of this particular security, or you want to take the positive side? I'll take the negative side. And we would argue, right, on air. We would argue, you just don't know what you're talking about. And it was great entertainment. But one side or the other would just be. And the other thing was, they would also call you up and say, hey, to your point, hey, we need you to talk up gold. Okay, great. I can talk. The sign of a great analyst is being able to argue either side of the equation. And so I would get a phone call. Sometimes it wouldn't necessarily be me on the air, but it'd be somebody else. And they would call me and say, hey, Browning, tell me why I should buy gold because I'm on CNBC in a few minutes. And I would give them my thing, or why should I buy munis right now, or why should I sell munis or buy XYZ stock? And I would give them the information because they were driving or they were sitting there on the set and they didn't have access to the information. Because you wonder how they immediately know all the answers to any stock question. It's because they're getting fed that information. No one can keep track of it that quickly. Nobody knows that much, right?
You don't see the earbud wrapping around the back of their heads. What's interesting now, to your comments before about the changes, when you see the talking heads on the show, especially if they're a portfolio manager of some kind, they now have the blocks, the disclosures on the side of them on the screen. It says John is long Apple, John is short Tesla, right? So it's now disclosed. So if they're talking about a position or the general direction of the market, you can see if they're bullish or bearish on tech or whatever it is. So there is a lot more of that transparency. What was the word I told you?
Very important at this point, just to remind everybody, this is not investment advice. This is just, our opinion, and we need to talk with you directly. And we're happy to do that. Just reach out, and we're happy to give you independent investment advice, but we can't do that on this channel.
Financial planning is not one size fits all. We are constantly thrown comments or questions on something very maybe specific by people, and my standard answer is, it depends. It's not that I don't want to give them an answer. It's not that I'm deflecting or I don't know what the answer is. The answer is it depends. Because if you're asking me for 50 people in a room what the right answer is, I'm going to say it's 50 different answers. Because every person's situation is different. Your bank account, your wallet, your timeline, your age, your health, your income, whatever it is. And so there is no everybody wears a size 9 shoe. Some of the stuff that's going on and why I called you into this as well is the term dead cat bounce and catch a falling knife. And so as the markets have unraveled, the question now people are throwing out is, where's the bottom? When do I start buying again? Should I dollar cost average? And again, you and I are professionals and we know how to address or avoid giving that direct answer to somebody without knowing more. Like a financial doctor, I'm not giving you a prescription without running the tests to understand the problem I'm diagnosing the prescription for. And so when somebody says, what do you think about Apple? Well, I love Apple, but I don't know if Apple's right for you. I don't know how much Apple you should own. What if your portfolio already owns 17% of Apple? Well, you shouldn't be buying more. You should probably be backing out, right? So the catch, dead cat bounce is we've been trending down depending on what indexes you follow, the Dow, the S&P, the NASDAQ. They reach down different degrees, percentages, and certainly relative to their moves up, but the tech stocks have been the hardest hit. And so, of course, people say, oh, if you liked it at 300 and now it's at 150, now's the time to buy it. Well, you and I have experience in knowing, like in the dot-com bust, that wasn't true. And so that falling knife commentary is when stocks are in some level of a free fall, our instinct is, oh, that might be a good time to buy, and I start stepping in. So then you knock the knife off the counter, you want to grab what fell off the counter, not realizing it's a knife, and now you just sliced your hand. And so you don't want to catch a falling knife, and so you don't want to buy into stocks potentially prematurely. But again, as you and I have talked about, it's about having a discipline and a game plan, not just shooting from the hip saying, this is a good buy.
Well, I think the same thing would have probably been said at one point in time with just put everything in IBM stock, just put everything in, I mean, I can come up with the names. How about Boeing? I mean, it's not that any of these are bad, horrible companies. How about Xerox? Xerox was the darling. GE. I remember as a stable part of our portfolios at one point, GE was always the go-to. We needed some place to, just blue chip that would pay a nice dividend, that would be steady Eddie. Well, what has happened to GE and GM and Ford? Another couple. That phrase, just put everything in these two or these three or these FANG. How about FANG and Netflix? You want to talk about what happened to Netflix the past?
But again, let's be fair. The FANG, the Netflix, like people made boatloads. If you were early investors, even midway investors, they had that hyperbolic appreciation. But to the point, getting in is easy, getting out is hard. What's your discipline and what's your exit strategy? Because somebody has to be the first one out the door. Somebody has to be on the Titanic. And when somebody yells fire in a crowded theater, somebody's going to be the first one out the door, and somebody's going to be in the back, and they're going to get locked out, and they're going to erupt, right? They're going to go down with the ship. And so Wall Street, unfortunately, is kind of the same thing. Is once you see these stocks starting to drop, where's the bottom? How do we know, you as an individual investor, how do you know, like, this is real this time? Versus as Lucent was moving up in the late 90s, every retrenchment was met with another bull run, and it would pull back and take a breather and another bull run. And this is a stock that went from 3 to 80. And then when it started to crack and the dot-com bubble was breaking, the 80 went to 70. Oh, it's a good time to buy. And then it went to 60. It's a good time to buy. It went to 50. And so people were dollar cost averaging all the way down without ever stopping to say, gee, it's at 80, now it's at 40. Maybe I should be just grabbing these profits and getting out. Instead, they're buying more. They're taking a home equity line. Because they think the paradigm was it's going to go back to 80. Well, it went to 75 cents. There's a lot of damage in that Lucent stock. So listen, we're going to do a 2-part episode. I'm looking at the clock. We got more topics to cover. Let's bring today's episode to a close. People can pick up the conversation next week. This is Ask the Planman with John Browning at Guardian Rock Wealth. We're here to tell you the things Wall Street doesn't want you to know. So far, we've talked about distribution channel, selling high versus selling higher, right? Buying right, rotating of stocks, asset allocation. We touched on catching the falling knife. We're going to pick up the conversation next week. We're going to talk about dead cat bounce and other ways that you, our listener, can protect your portfolio. John, thanks for joining me, and we'll see you on the next session.
All right, we'll see you then.